Hello. The company being analyzed today is Bharat Seeds Limited. This company is an auto component manufacturer. Basically, it manufactures parts for automobiles. And in Bharat Seeds case, in this company's case, they manufacture car seats and majorly car seats and car carpets. So carpets for cars and seats for cars. So the purpose of today's segment is going to be analyzing the company's financials, its balance sheet, its cash flows, what the company actually does, what it sells, and few more things. Consider this an intro to the company's business. So let's start. First, we have the market cap right below me. Market cap of 1001 crores. So the company recently hit a crore in market cap and is a small cap company. So small cap. The current price of one share is 159 rupees. The book value of one share is 31 rupees. Book value is total assets minus total liabilities. So the net assets of a company is the book value. So book value per share is 31 rupees. So current price is more than five times book value. Then ROCE, return on capital employed. Important number, 15.6%. Nice. Not the best, not the worst. Pretty all right. Return on equity, 18%. Okay, 18% is nice. ROE. So ROE, ROCE, medium to high. Then let's take a look at the company's financials. Here we have the profit and loss all the way from 2014 to 2025. Here you can see we have the sales. All of these are in crores, by the way. Sales, operating profit, OPM, operating profit margin. We will take a look at this also. Profit before tax, and finally, net profit. The tax percentage is the tax percentage it pays, and it seems to be paying taxes. So that's a good thing. So let's start with the sales. In 2014, the company reported sales of 560 crores, an operating profit of 29 crores, with an operating profit margin of 5%. So not a very crazy operating margin. In fact, a pretty low operating margin of 5%. Okay. Then let's move fast forward to 2018. 970 crores of sales. Then COVID happened. COVID, so of course, sales went down. So let's go to 2022, where we have sales of 818 crores. Then move forward all the way to 2025, fiscal year 2025, where we have sales of 1,289 crores, operating profit of 75 crores, 6% operating profit margin, profit before tax of 44, and finally 33 crores of net profit. So after seeing the sales figures, you can see there has been a noticeable increase in sales, very noticeable increase in sales. So what were the growth rates in sales and profits and all that? So compounded sales growth over the last 10 years was only 6%. This can maybe be attributed to the COVID decline. The COVID decline was so massive that the recovery, even after the recovery post COVID, the sales have only grown by 6% year on year. Annualized growth has been 6% over the last 10 years. Last 5 years has been a really nice 17% sales growth. Okay, annualized. Last 3 years has been 16% sales growth, and trailing 12 months, TTM, last 12 months, 27% sales growth. Let's take a look at the profit growth where things look even more rosy. 10 years, last 10 years, the compounded profit growth has been 15%, which is great. Last 5 years has been 21%, extremely high. Last 3 years, 40%, and TTM, trailing 12 months, 31% profit growth. So, immense profit growth, nice sales growth, and profit growth has outstripped, has gone faster than sales growth. Then let's look at pre-COVID, okay? Pre-2020, here it shows sales growth numbers also, okay? So before 2020, minus 6% 2014, 23% in 2015, then 2016, 2017, both positive, though 2016 only 0.9%. 2017, 2018, solid 15, 20% sales growth. Then 2019 was like, I think, GST and all that took place, demonetization and all of those effects added up and led to a slower economy. 2020, I guess COVID, then came the recovery. Okay. 2021 still affected by COVID, and then 2022 onwards, we saw the post COVID recovery. Then, uh, return on equity. Yes, here we see the company is showing rising return on equity. Now, 5 years ago, return on equity was 13%. Again, could be due to COVID. But post COVID, let's say 3 years ago, 17%. Last year was 18% return on equity. 10 years ago, 16%. So we have seen a stable to a rising return on equity, which is pretty nice. So these were the financials. Here I can show the cash flows. All right, cash flow from operating activities. The company is a positive cash flow company. All right, as you can see, let's pay attention. Okay, only pay attention to cash from operating activity figure. 2014, that was 36 crores. Okay, 2017, 38 crores. 2018, massive jump, 69 crores. That was a one-time jump. Then from the last 2022 onwards, 2022, 2025, the company has seen rapid cash flow growth from 16 crores in 2022 all the way to 96 crores in 2025. The last 4 years, great for cash flow growth. Also, if you're wondering in cash flows, the company's working capital changes are positive. Okay, here you can see, okay, working capital changes down here, they're positive, which contributes to cash flow. All right. Uh, and they are working capital positive primarily due to payables. Okay, trade payables have increased so massively compared to revenue and even receivables, which means the company is having improved terms on which it's taking supplies from suppliers. So it's able to take supplies from suppliers on a better credit term, is what I'm trying to say. So payables have increased a lot rapidly. It means better terms on which it's getting the supplies from suppliers on credit, which leads to more and more positive cash flows, better cash flows. Let's take a look at the company, what it actually does. Here we are at the company's, you can say, the annual report. And from here, you will find out what a company does and more info about the company itself. The balance sheet will also come, so stay tuned. Now, here they mentioned, okay, sales of car seats to Maruti Suzuki India Limited. The company's major revenue source is that it sells car seats to Maruti Suzuki India. All right, it's one of the key suppliers, maybe one of the two key suppliers of car seats. Maruti Suzuki India has an ownership stake in the company. It's one of the promoters of the company, and they have a partnership, Maruti Suzuki India and Bharat Seats. So it's very reliant on Maruti Suzuki's sales. All right. So it sells car seats to Maruti Suzuki India. Okay. Then the company has also started supply of two-wheeler assemblies. Okay, two-wheeler wheel assembly to Suzuki Motorcycle India Private Limited. So Suzuki Motorcycles, the company is now the sole supplier of wheels for two-wheelers for Suzuki Motorcycle India. So this is the new major revenue source, new source, potential source for the company. Okay, new revenues, new line of business. Then the company has started supply of seats for four-wheelers to Maruti Suzuki India Limited from the manufacturing facility set up at Kharkhoda in Sonipat, Haryana. All right, all right. So car seats to Maruti Suzuki, um, yeah, car seats, then supply of car seats for four-wheelers, okay, and now started supply of two-wheeler wheels to to Suzuki Motorcycle Limited, Suzuki Motorcycle Limited. Moving on, we have, okay, its future R&D plans and R&D expenditure. So it seems the company is going to spend 165 lakhs, 1.65 crores of capital. Okay, one of the expenditures is going to be capital. Then recurring expenditure is going to be around 10 crores. Total expenditures are out to be 11.68 crores. Research and development expenditure and R&D expenditure as a percentage of total turnover is only 0.91%. So company is spending only 0.9% of its revenue on capital expenditure. Moving on, we have, yes, okay. The company is currently operating primarily under a single business segment, okay, manufacturing complete seating systems and interior components for passenger cars as well as utility vehicles. So, an auto component manufacturing company manufacturing complete seating systems. That's one of them. And the second is interior components for passenger vehicles. Moving on, we have key financial ratios. Now, first, we have the debtors turnover ratio. Basically, it shows how well, how effectively a company collects its credit sales from its customers. Basically, higher this ratio, better, or it declined this year. Okay. Inventory turnover ratio, again, higher this ratio, the better. It declined this year. So, all right. But these numbers should be seen over a longer period of time. And both these metrics, debtors turnover, inventory turnover, shows how good the management is with managing cash flows of the company. All right. Then we have the interest coverage ratio. This is the EBITDA of company divided by interest payments. That is interest on loans. Higher this ratio, the better. If it's less than one, it can be very concerning. It can be concerning. More than one, okay. Higher this ratio, the better. And interest coverage ratio is 8.8 times, which is really healthy. 8 is a really, really healthy interest coverage ratio. So nice. It can easily pay, easily cover its interest payments on loans. Current ratio, current assets divided by current liabilities. If it's less than 1, as you can see, current ratio is 0.8 right now. It's not concerning and it depends on the industry. It's not the, okay, it does not mean it's doomed, the company is doomed, but it depends on the industry. If current assets being less than current liabilities is exactly a red flag or no. An operating profit margin 4.1% for this year. So again, very low profit or operating profit margin company. Net profit margin again really low 2.5%. So this is a pretty low margin company, low margin company. And return on net worth. All right, net worth here is shareholders funds plus equity 16.8%. So pretty decent return on net worth. Moving on, we have the company's balance sheet. Yes, the consolidated balance sheet of the company. Here, let's take a first look at the non-current assets. These are assets which cannot be converted into cash within 1 year, like the company's buildings and plants and all that. And all these numbers are in lakhs rupees, as mentioned here to my right. No, here to my right. Yes, in lakhs rupees. So it's total non-current assets like its property, plant, equipment, like its right of use assets, long-term financial assets, maybe some bonds it purchased, company purchased long-term. They amounted to 38,512.27 lakh rupees, 385 crore rupees, non-current assets. Then current assets, assets which can be converted into cash within 1 year. This represents the liquidity of the company. All right. In many ways, an important part of the liquidity of the company. Here we have current assets, total current assets of 26,258.11 lakh rupees directly below me, or 262 crores of current assets. Total assets are around 647 crores. Okay, okay. And here you can see directly below, we have trade receivables. All right. We have a trade receivables. Out of the entire 262 crores of current assets, 196 crores is trade receivables, And trade receivables is basically when the company has supplied goods to its customers. It has already supplied the goods, but they will get the money back from customers after a certain period of time. Let's say 30 to 60 days. Okay. So the money the company is supposed to receive from customers after supplying goods, that's trade receivable, is supplying goods on credit. Cash and cash equivalents of the company are only 2.95 crores. So dominated by trade receivables, not a lot of cash on hand by the company. Then we move to liabilities. First, you go to non-current liabilities. These can include long-term borrowings and all that. Around 124 crores. So way less than total non-current assets. Then we come to current liabilities. These are around 328 crores, more than current assets. You already saw the current ratio was around zero point 0.8. Again, this is dominated by trade payables. Okay, trade payables are close around 250 crores. There are around 257 crores of trade payables. What are trade payables? Basically, the company gets supplies from suppliers, right? Like raw material supplies and all that. It doesn't pay for them upfront. It will pay for them after a certain period of time. Got it. So we saw current assets, we saw current liabilities, not a lot of cash. It's dominated by trade receivables and trade payables. The current balance sheet, you can say. The balance sheet, when talking only about current assets and current liabilities, it's dominated by that. Then moving on, we have this year's the income statement. One thing I want to show is this expenses. Under expenses, it's marked here cost of raw materials and components was this number, okay? These are in also again in lakhs, and you see this percentage 83%. Around 83% of revenue is consumed by cost of raw materials and components consumed. So cost of raw materials and components consumed have an 83% share of revenue, just gone by that. The biggest expense. Second biggest expense is other expenses. We will take a look into that. Then employee benefits expense is 53 crores. Okay. These numbers are in lakhs. So 5,314 crores. Sorry, 5,314 lakhs. That's 53 crore rupees. So employee benefits expense, that's around 4% ish of revenue, employee benefits expense. Moving on, we have the cash flows. Okay. The cash flows of the company. Here below me, it's marked increase or decrease in trade payables. And you can see there's a massive increase, 115 crores increase in trade payables. And this seems to be very common for the industry, that trade payables risen so much that they lead to positive cash flows. All right. And if you're wondering why trade payables rising lead to positive cash flows, it's because more your payables, higher your trade payables, meaning the less money you have actually paid to suppliers, the less cash you have actually paid to suppliers for supplies of raw materials and all that. Okay, so cash flow means real cash taken out, going out of the bank account of the company. So more the trade payables, meaning you have not actually paid suppliers yet, you will pay them later. Money will be paid for some time. Then moving on. The segment is about to end. Sale of goods. Okay. Revenue recognition. How does the company actually recognize revenue? Very important. Revenue from sale of goods is recognized at the point of time when the control of assets is transferred to the customer, generally on delivery of the goods. Okay. And normal credit term is 30 to 60 days on delivery. So normal credit term, they get paid after 30 to 60 days after delivery of the products. So that's how revenue is recognized. Okay, that's good. That's good. Revenue being recognized only after delivery of products. Finally, uh, how is revenue being divided? Okay, So out of the one, okay, again, these numbers are in lakhs. We make this a bit smaller. Yes. So out of the total revenue of 1,282 crores this fiscal year, around 1,000 crores, massive amount, came from seating systems. So selling of car seats, selling of seats basically to automobiles. Second biggest source of revenue, around 54 crores. So highest is 1,000 crores, then 54 crores came from carpets, then extrusions, which is materials being molded into certain shapes for certain uses, but very small source of revenue, only 15 crores. Others, we have other section, 124 crores, which they have not mentioned. All right, interesting. And revenues were dominated by India. So 1,285 crores of revenue. Out of that, sorry, 1,000, out of that, only 3.35 crore, okay, only 3.35 crores of revenue actually came from outside, from exports. Majority of revenue came from India, domestic itself. So that was the annual report. Finally, let's take a look at the company's credit report. Now, this is a credit report of the company released by one of the credit rating agencies. Here, in this case, ICRA. Yeah, ICRA, ICRA. Here, I want to show only two things. One, how can I show this? Um, how can I show this? All right, there's a line below me. Okay, line below me. Year-on-year growth of 8.5% and 13.8% in fiscal year 2024 and 2025 respectively for seat volumes sold to MSIL, which is Maruti Suzuki India Limited. All right. So volume growth in the number of seats actually sold was 10.9%, 10.5% in fiscal year 2024 and 13.8% for fiscal year 2025. So double digit volume growth also. Then next thing I want to show was this. Yes. Here they've highlighted high client concentration risk. Okay. 85% of revenues is generated by selling to MSIL. MSIL, Maruti Suzuki India Limited. So around 85% revenue comes from selling to MSIL, and 85 to 90% of revenue comes from selling to MSIL and SMG. SMG is Suzuki Motors, I believe. Suzuki Motorcycles. So Maruti Suzuki is a major customer. 85% of revenues come from them only. So that was all that I wanted to show. So in summary, Bharat Seats has seen some pretty good revenue growth, has seen some really, really nice profit growth, comfortable interest coverage ratio, current ratio. Okay, we saw that the non-current liabilities, if I'm correct, non-current liabilities were way lower than non-current assets. Current liabilities are more than current assets and dominated by trade payables, trade receivables. All right. Good cash flow growth, good cash flow growth. And it seems the company, like it seems like many other companies in the auto component sector, it receives money from customers before it pays money to suppliers. So it sells the goods, right? It gets the money from customers, then it gives the money to suppliers, creating this positive cash flows that's generating massive cash flows for its size. 97 crores is pretty good. And what else did I want to say? Uh, High client concentration risk. Again, Maruti Suzuki, and Suzuki Motors. Wait, okay, Maruti Suzuki and Suzuki Motors, they both are promoters of the company. They have a stake in the company's ownership. All right. And the company showed good volume growth and stable return on equity. And we didn't see it, but the company did have stable or rising return on capital employed after the COVID bust. So post COVID, it's doing better and better. So it relies a lot on the success of Maruti Suzuki and success of Suzuki Motors, Suzuki motorcycles, all of them. The more products they sell, the more volumes they sell, higher will the company's revenues grow. Because it's a sole supplier, it's one of the key suppliers to the company for like car seating systems and carpets. Low margin company, only 5 to 6%. We saw like 4 point something percent was the operating profit margin. Net profit margins were 2%, so very small margins. So that was it. My nose sucks. That was Bharat Seeds Limited. Have a nice life.